Hello and welcome to today's webinar, Financial Fitness Steps to a Brighter Future for Your Business, hosted by Steve Grice from Jones Corporate Finance. Before we start, I have a few housekeeping items to cover. First, we'd love to hear from you during today's presentation. If you have a question, please feel free to send it through the Q&A tab at the top right of your screen. This can be submitted anonymously if you would prefer to do so. We'll be answering questions at the end of the session, but if we don't get to your question during today's webinar, we will be sure to follow up afterwards. Also, just to let you know, today's webinar will be available on the Jones Corporate Finance website after the live session. So without further ado, I will now hand over to Steve. Steve, over to you.
Okay, morning everybody. Thanks for attending. What I'm going to talk about today is basically financial fitness. So we're going to go through a number of areas. We're going to have a quick look at the general economic outlook at the moment. Then we're going to go through general financial fitness. And we're going to have a look at borrowing fitness in particular, and whether this can be used to facilitate growth or whether it's set up to trip you up. We're going to finish by having a quick look at the current funding landscape, and then we're going to take any Q&As if there are any. So we're going to look first at economic headwinds. It's a really interesting time at the moment. I don't think since 2008 any economists have been able to predict what's going to happen next. The big thing at the moment, obviously, is the effect of the pandemic. And the big thing here is what's going to happen with behavioural changes. So what this means is not just how it affects you and your business, but really how it affects your customers and how it affects their customers. Because at the end of the day, at the end of the supply chain, there's always a customer. And it's their behavioural changes and how the pandemic regulations have affected them and whether they get back to normal quickly or not, that's going to have an impact all the way back up the supply chain. It's going to hit some sectors more than others, hospitality and retail, for example. But that just doesn't hit hotels and bars. It also affects people who supply those sectors, food and drink, manufacturers who do the fittings for those sort of outlets, shop fitters who actually install the new stuff. Now, at this stage, we don't know whether that's going to mean a reduction in demand for all that sort of stuff, or whether it's going to mean an increase as people flock back to hospitality, and there's going to be a boom in new bars and new restaurants and new hotels. At the moment, it's quite finely balanced, and a lot will depend on, I guess, whether we have another lockdown over the winter. Next major thing is inflation. It's coming. Everybody is talking about cost of living crisis coming for at least over Christmas. Partly it's a result of increasing wages due to labour shortages, but there's also things like increased transport costs, increased power costs, and these things all have a knock-on to other sectors. There is the potential for stagflation coming along as well, and this is defined as an economy that's got high inflation, low economic growth, but high unemployment. Now, at the moment, we've arguably got two of those. We've got high inflation, arguably we've got low economic growth. In the summer, GDP growth was quite high. Now it seems to have knocked back a bit. Where that goes in future, anybody's guess. The one that we haven't got at the moment is the high unemployment, and it's difficult to see that that is going to go high at any point over the next year or two, just because of the labour shortages in the market. But like I said at the top, no economists have been able to predict what's going to happen next since 2008. So we'll see. Another issue that's on the blocks at the moment is, well, good old Brexit. And one issue coming down the tracks that has been fudged up to now and will continue to be fudged is Northern Ireland and the effect of the agreement there. David Frost was making some bellicose noises at the Tory Party conference this week about it. In my view, it's not whether it just affects trade to Northern Ireland. It's more about how what the impact is on deteriorating relations with the European Union and any tit-for-tat retaliation. Hopefully we can avoid all that sort of thing, but if we just act unilaterally, then that doesn't bode well for future relations. So that's something to keep an eye on. Energy issues generally, and we're talking medium to long term here rather than the short term issues that we've got at the moment. So there's things like the climate levy, decarbonisation, all these sort of things are going to add costs in over the next 5, 10, 20 years. It's also going to provide opportunities as well for some sectors, so that's potentially positive. Government borrowing, there's a lot of government borrowing about at the moment, but it's fair to say that it's costing us tuppence halfpenny to service it at the minute. The argument is that it's going to be paid back at some point. At the moment, all I can see is that we'll keep rolling gilt issues for the next 50 years, and we'll grow the economy and the debt will shrink as a proportion of GDP. It still needs to be serviced, but with interest rates as low as they are, that's not too much of a problem at the moment. The biggest effect on the economy is the point that I've got at the bottom there, I think. It's on consumer and business psychology. So I just come back to the point at the top. Do we feel good about the future? And not just do we as business people, you as business people, feel good about the future, feel good about investing in that new CNC machine. It's about consumers. Do consumers feel good about investing in a new car? Because in our current economy, that kind of underlies everything else. It's talking about the end of the supply chain, like it was at the top. Some sectors are definitely going to benefit from changes in psychology. So new housing, for example, or business startups, small business startups, more so than large. As people reappraise their lives, they want to move from the city to the country, they want to have a better quality of life, they want to have their own small coffee shop or something like that. But what do you do if you haven't got the means to step away from a lifestyle that you don't enjoy anymore, or the pandemic has made you see that there is an alternative? There's an awful lot of people in that sort of situation. And I guess the question is, how do they feel and what's their propensities to spend money like? That's going to have a knock on. That's economic headwinds. Then we come on to general business fitness. So how can we either weather the storm or take advantage of the opportunities, depending on what your attitude is to the issues in the first slide there. What I've got here is a few simple ideas, just picked out at random. There are many, many more, okay? So things to think about: over-reliance on a single customer. A friend of mine who's a business doctor has this concept of Switzerland. Make your business into Switzerland. Switzerland is famously independent. They don't tend to rely on anybody. If your business is over-reliant on a single client, you are very, very subject to their whims or to their changing ownership or changing investment patterns, changing product lines. It's always best to not be too reliant on one particular client. I remember back in 2008 seeing one client who was 90% reliant on one particular car factory that had just shut down, and they had nowhere to go. It might be that this isn't something that you can do immediately. It might be a function of your product range, your product expertise, that you can't actually switch out that quickly or grow another client base, but it's definitely something that needs to be front of mind and that you need to be thinking about. There are things that you can do to ameliorate it short term. So, have you got written contracts? Have you got sole supplier status? Is there any intellectual property involved that you own? Is there any tooling that you've got possession of? What are your clients' costs of switching? And an interesting point is, if you want to expand your customer base quickly, then one option is to maybe buy a competitor who's got a different client base or a slightly different sector that they're into. Another thing to look at is margin pressures. So there's some obvious levers that you can pull here. Putting surcharges on invoices, petrol, transport, steel, so that any price increases that you get from your suppliers automatically gets passed on to your customers. Obviously, that's a process of negotiation, and it comes down to the relative power that you have and your client has, which comes back to what I was just saying about, are you over-reliant on a single supplier? One of the things that I really like on margins is the power of 1%. And this is a concept that I was introduced to many years ago. When you're looking at, let's say, your next year's business performance, and you want to increase profits, for example, if you want to increase profits, you might give yourself a target of 1%. I want to increase my profits by 1%. Now, there's lots of different ways you can do that, and that becomes slightly nebulous. Whereas if you look at some more targeted ideas, like I want to increase my turnover by 1%. Okay, well, there's some very specific things that you can do around that, like increase sales to existing customers. For example, what are they buying off you that they're not buying off at the moment? Increase sales to new customers. What's your sales process like at the moment, etc., etc. That's much more targeted, and there are much easier levers that you can pull around that, rather than just saying, I want to increase profits by 1%. And then you come on to things like, I want to increase my margin by 1%. So you have a number of levers, very specific levers that you can pull there. So it's better buying, it's reviewing your suppliers, it's doing bulk discounts, things like that. And then there's also things like costs. So I want to reduce my overheads by 1%. Okay, there's some very specific levers that you can pull there. And what the power of 1% means is that if you increase your margin by 1%, if you increase your turnover by 1%, and you decrease your overheads by 1%, the cumulative effect of all that adds up to something like a 4 or 5% increase in net profit, which is a lot better than just a 1% increase in net profit. So it's where you're targeting that 1%. That's something that's very powerful, that's always stayed with me ever since I learned it. The other main thing that you can look at, especially at the moment, is collection of cash. So I'll come on to it more later, but basically, if you're thinking that the economic headwinds are negative at the moment, surrounding yourself with cash is always a good thing to do. One of my favourite quotes, again, is a sale is a gift until it's paid for. So if you make a sale, until somebody actually pays you for it, you're just giving it them. There's also the old quote about turnover is vanity, property is sanity, cash is king, and the most important line of that is always cash is king. There's other things that you can do within that. Do you want to sack some of your bad payers? Do you want to implement a grading system so that your best payers, you spend most time on them? Those are your gold customers. Simple things like, if you've got a big client, if you've got a single big client, the people that you interact with to take the orders from aren't necessarily going to be the people that you interact with to collect payments from. So keeping on the right side of the payments department is always a good idea. Next time you're in there, drop the girls in the payment department a box of chocolates. make sure they know who you are, make sure they are well disposed towards you. So when you phone up to say, I really need that payment today, they'll know who you are and they'll be more, potentially more willing to do it. The other point is task someone very specific within your business with collecting that cash in. That could be you, it could be somebody that you delegate to. The phrase Rottweiler is normally used in that context. You need somebody who is very tenacious, who won't just be fobbed off and who will be persistent in collecting the cash in. Okay, so this brings on to specifically borrowing fitness. Okay, so all the previous get your business into better shape generally. It might be the case that you have no existing borrowing. You've got a positive working capital cycle, which is great. You know, you've got cash in the bank. You're not reliant on anybody. You're not servicing debt. But ask yourself the question: is this holding you back? Could you increase sales, for example, by offering longer credit terms? Could you increase margin by paying suppliers quicker for a discount? So the working capital cycle that you've got at the moment might be positive, but there might be a business benefit in changing it to be negative. If it's negative, you're going to need some borrowing. It's something to think about. If you have got existing borrowing, it's often worth doing a review of it at a regular point, at least once a year. The whole point of that is going back to this idea of wrapping yourself in a blanket of cash, particularly to uncertain times. So if you have existing borrowing that's sucking cash out of the business, do you need to do something about that? I see lots of businesses at the moment who have taken multiple loans, multiple short-term loans. And the point about those is they tend to be only over 1 or 2 years. They tend to be fairly high interest rates, and they tend to take a lot of cash out of the business. I've seen businesses with 5, 10, 15 of these, and all the cash that they're generating is going out on loan repayments. Now, that's obviously a problem. What do you do about it? Well, that's where the borrowing review comes in by people like Jeremy's, to be frank. You can often spread these loans out over a longer loan. You can maybe use things like the government recovery loan scheme to do so. There are lenders out there who will look at that consolidation. So it's about talking to an expert and seeing what's possible in the market out there, and we'll come onto the current lending market later. Other things to look at with your existing borrowing is, okay, so there's the basic factors. Is the term right? Is it too short term? What's the longest term that's possible? Do you want a really long term, say 20 years, or do you want to pay it off shorter? Are there better options out there elsewhere with better lenders? Now, I'd suggest that the days of shopping around for the best rate from a lender are over. They've been over for a number of years. The current market rate, interest rate for business loans is between 5 and 20%. And you're not going to have loans, one loan at 5 and one loan at 20%. If you've got a loan at 20%, it's likely all your loans that you have are going to be up at that end of the scale. There are definitely better lenders out there than others. And if you're not shopping around on rates, it comes into other factors such as what's their attitude to forbearance? What's their attitude to collection if you have a problem? We know all these various lenders out in the market. We can see what they do with other clients. If you're only dealing with them on a one-to-one basis, you haven't necessarily got all the rest of that information around you as well. So calling in an expert to advise on the debt is always the best thing to do because they have a full market picture. Another thing to consider is the security package on your existing borrowing. The basic idea is it overkill banks, high street banks, are pretty dreadful for taking as much security as available when they don't need it, to be frank. And there are a lot of historic positions out there where people have banked with one bank for many years, and that every financial product they've had has been from that bank, and the bank has got everything as security. So they've got a company debenture, they've got specific charges over specific assets, they've got guarantees from directors, they've got charges over directors' homes, they've got all kinds of cross guarantees between subsidiaries. And the amount of borrowing that you might have with them might not warrant that level of security package. Banks will always take it if it's available. And their argument will be, well, we're not letting it go, because if you want some borrowing in the next year or two off us, then it makes it easy. We don't have to put it back in place. To be frank, that does not help you with the bank. The security package that they have does not make them more liable to lend you the money. That's just the way the market is at the moment. What I'd always suggest to a client is that you split your security package. So your lenders just take exactly how much they need and no more. So it might be that they just take a charge over your debtor book if you have invoice finance. It might be that if you have a small loan, they just take a personal guarantee off you. It might be that if they have some asset finance with you over particular pieces of kit, they don't take a debenture as well. They don't take a personal guarantee off you. They just take a charge over that particular piece of kit. So that's something else that can easily be looked at. And there are a number of lenders out there who are a lot more flexible on that particular point than the high street banks. I mean, the basic impact of a we want it all security structure means there's little left for the lenders if you need them. One thing to look at in particular with existing lending and any lending that you're about to sign up to is the negative pledge clause. A lot of loans contain a negative pledge clause, and this basically says that you pledge to your lender that you won't take on any other borrowing without their permission. Well, that's fine if they're your main lender and you're lending £10 million off them. You can see why they do that. But people like Funding Circle have this sort of pledge written into all their loan contracts for amounts as low as 25, 50,000, which might be nothing in the context of your business, but they will still have this written in anyway. Now, the idea that you have to get the permission of your lender to take on more lending from another lender is all well and good. Generally, the best lenders don't withhold permission. They let you do it as long as you let them know what's happening, and being open and transparent with all your lenders is always the best policy. Generally, permission's not withheld, except for Funding Circle. We have had real problems with Funding Circle allowing borrowers to take on anything else from anybody else, even when it makes a good business sense and it doesn't disrupt their security package. They have, I can't think of a time of an instance where they've said yes, that's okay. They've always said no. If you want to take on that lending out there, then you need to refinance us out as well. I guess you can understand why they do it, but it does create some inflexibility in the system. It means you need to borrow more than you were anticipating from the new lender. That's something to watch out for. Okay, so how do we facilitate growth through borrowing? The obvious thing is working capital. And we've already talked earlier about your working capital cycle, whether it's worthwhile changing that. from maybe a positive to a negative, or one where you need more cash in the business, more borrowing to support a slightly different working capital cycle. But there's also things like opportunities of taking on new clients from competitors that haven't made it or are suffering in the current circumstances. Opportunistic stock purchases as well. With prices rising, it's quite often good to fix in that level of costs if you have the cash to do it. There's also things like when competitors do actually go, but can you buy their assets? Can you buy their plant and machinery? Is it going to be of use to you? There's no doubt that there are a lot of bargains available. And one of the things that we'll talk about is in the next couple of slides is how you go about buying a competitor. That's one of the key areas at the moment where we're seeing borrowing used to grow a business. The other obvious ones are, if you are seeing expansion because you're in one of those sectors that's growing at the moment, do you need to upgrade your plant and machinery? There are a lot of asset finance companies out there, not just doing hard assets such as CNC machines or whatever. There are a lot of people out there doing soft assets, IT equipment, office fit out, things like this. There's also the opportunity to refinance or raise cash against your existing unencumbered assets. So if you have a range of machinery that's got no finance against it at the moment, there are a number of asset finance providers out there who will refinance that for you. And again, coming back to the security point, we just make sure that they take a charge just over those specific assets. And that can often be a cheaper way of lending than going for an unsecured working capital loan. One of the other things that I've seen with a client lately is they have altered their business model. So in that particular case, they were working with a particular large client on free issue material. They've now switched to a model where they're buying in the material and then reselling it to the client. There's more work involved in that, but it just creates a higher margin. There is substantially more profit in that for that particular client in that particular sector. Now, that's going to need more working capital because you have to finance the purchase of the stock. So things like that, where you're changing your business model, are another opportunity. And again, plenty of lenders out there who will look at that sort of thing with you, provided you've got a decent track record. And well, actually, that brings me on to the next point. Lenders are a lot more picky nowadays. At the moment, there is always a lender out there for something. We can always find generally some way of doing what you want to achieve. Just because lenders are more picky doesn't mean there's reduced choice out there, because there are a lot more lenders. For all sorts of reasons within the global finance market, and lots of money looking for a home, and people looking for better returns from pension funds, investments, etc., etc. There is a lot of cash being pushed towards SMEs. It all has different flavours, it all has different restrictions on it. Some funds might like property, some funds might like working capital, some funds might like management buy-ins and buyouts. There are a whole range of different lenders. I'll come on to the fragmentation of the lending market later on, but the basic point is there's always somebody out there to do something. Generally, the main lenders have some flex to ignore what's happened over the last 18 months, because generally a lot of businesses are going to have a fairly torrid time of it. So they've got some leeway. CCJs, if you picked up any of those on your business, that's going to be an issue, particularly if they're unresolved. Liquidations is always going to be an issue if you've got some businesses in your past that you've had to put down for whatever reason. And it may be that there's a story there and we can help you tell that. And again, we know which lenders that will be an issue for and which lenders it won't. It all depends on the circumstances. This is one of the reasons why you'll never automate lending. It's very, very particular to particular circumstances and particular lenders. So, next slide. How can your existing borrowing trip you up? We've already talked about some of these, like multiple short-term loans, creating a cash drain, but I want to pick out a couple of points here. So, prepayment penalties. When we're talking about refinancing from one lender to another, because it's a better security package or it's a longer term or whatever, prepayment penalties can sometimes be onerous, and these aren't the things that you typically tend to look at the beginning of a contract. Maybe there tend to be that prepayment penalties tend to fall away over time. So the longer that you've had a particular loan, the less likely there's going to be prepayment penalties. Having said that, I'm dealing with a client at the moment who's got a commercial mortgage with Lloyds, and they're looking at a prepayment penalty of, well, it's still around 30 grand, even though they've got a loan of about £500,000, and they've had that for a number of years. Lloyds are still insisting on the prepayment penalty being paid if they refinance. Now, in that particular case, there's a strong reason to refinance because what we want to do is switch that from capital repayment to interest only. There's good business reasons for that particular business to do that, and there's good tax reasons as well for the director personally. So it's almost a no-brainer. Lloyds won't do an interest-only product for this particular client. So we have to look at another lender. Well, if Lloyds aren't offering what we want, we have to go somewhere else. So the argument is, please don't charge the repayment penalty. We're still in negotiations around that. But for the purposes of this, I just want to flag up that that is something that you need to be aware of. Coming back onto the subject of security sharing, splitting, it also adds on, comes back to the idea of over-reliance on a single client, and that's over-reliance on a single lender. So from 2008, I've always advised clients not to have everything with one particular bank. Before that, there was probably really good, actually quite good reasons why you'd want to have everything with one bank. It did make it easier to negotiate. It was the case that, well, you know, you've got the invoice finance line, Mr. HSBC, so we want this commercial mortgage over here. We'd like you to have it as well. And you'd be more likely to get it because you had all your eggs in one basket. That situation has changed now. It is no longer the case that because you've got fairly substantial borrowing with your bank, they will give you further borrowing. Those days have been gone for the last decade or so. Customer service used to be, I mean, having everything in one place, in theory, should give you better customer service. It doesn't. I never advise clients now to switch banks. I advise them to switch bits of lending away from banks, but in terms of the main current account, the main banking facilities, there's no point in switching from Barclays to NatWest or Lloyds to HSBC because most banks are the same, particularly for small businesses, and we're talking, say, less than 3 million turnover. Customer service used to be a differentiator. It's not anymore. They're all much of a muchness. Their credit stance is much the same. The way they treat clients is much the same. Some banks are actively managing smaller clients away. And when it comes to it, have a think about what you really need a bank for and other alternatives out there. It used to be that you needed a bank because you needed a current account, you needed payment transmission mechanisms to pay your suppliers, to pay your staff, all that sort of stuff. Nowadays, there are any number of alternative banks out there who will offer current account services. So Starling Bank, Atom Bank, particularly if small businesses are a viable alternative. There are plenty of other banks who are coming with these sort of products now. So that's one thing that you don't need a bank for anymore. You certainly don't need a bank for borrowing, because there are an awful lot of lenders out there, some of whom are not even banks, but are perfectly legitimate sources of funds, and will be a lot more flexible, a lot more customer focused than the high street banks. So that's something else that you don't need a bank for. You don't need a bank for doing foreign exchange transactions anymore, because there's any number of foreign exchange providers out there. When it comes down to it, what do you need a bank for when you can do all the services that banks offer with any number of other providers? And the idea that you put all your eggs in one basket and you are reliant on one finance provider for all your business services, I think is an idea that has had its time. So, opportunities. So what kind of opportunities can having the right access to finance create? The obvious one, and one I've seen a lot of, particularly over the last 2 years, is refinancing invoice finance facility term loan. Invoice finance is great. I used to sell it for HSBC. It's great in the right circumstances. It suits some businesses fantastically well. Most businesses that have it, it suits the bank better to have it than the business who has it. And that's for a whole host of reasons. The point is, there are a lot of businesses out there with inappropriate invoice finance facilities. And I have heard invoice finance described in the past as the heroin of the finance industry. It's very difficult to get off it. The last couple of years has provided a really, really good time to switch something like that onto term loan facilities, particularly using various of the government schemes, which we'll come on to in a little while. Putting your invoice finance facility, refinancing it to a term loan, gives it an end date. It might be 5 years away, but once you've made all those loan repayments, the business is free of debt again at that point, and that gives you an awful lot more flexibility. Businesses that have invoice finance in them, we generally tend to find we have to be more creative in their finance solutions when they want new or different types of finance or finance to grow. So looking to get rid of that if you can is a really good opportunity. Acquisitions is another good opportunity at the moment, and as I said on the previous slide, there are a lot of bargains out there at the moment. So it could be a direct competitor who we're looking to sell. It could be somebody in a slightly different industry where you're looking to get into. You're looking to maybe diversify your business, expand away from one particular client or one particular sector. The easy way to do that is to buy another business and bolt it on. There is a healthy market for this kind of acquisition lending, particularly with businesses that have got a decent track record of profits in the last 18 months. notwithstanding. It is often the case that 2 + 2 equals more than 4 in a situation like this. And the lenders that have appetite to do this kind of lending will recognise that. So one of the things that we do at Jerem's Corporate Finance is when we take on a client who is looking to grow through acquisition, we will scout out the market and identify particular businesses that are either local to you, that are in a very similar sector. They're in a slightly different sector that you can easily get into. We can advise on all that, and in particular, we can advise on how to finance that. If you haven't got the cash in the bank already to go out and do an acquisition, that's not a problem. Most of these things that we see are financed, and that's even with very large buyers looking at quite small acquisitions. A lot of them tend to be financed because there is a lot of money out there looking for a home around this type of lending. The other opportunity is the opportunity of, as we've just been saying, diversifying your borrowing in the same way that you diversify your client base. Diversify your borrowing. It gives you greater freedom. So one of the things that we saw in the 2008 crisis is those businesses that had everything in one basket, particularly with the likes of, say, RBS. If there was one problem, they'd pull the whole rug. So you had, let's say you had a problem with your RBS invoice finance line, that would have a knock-on effect for all your borrowing. Whereas if you had your invoice finance over there and your loans over there and your asset finance over there, a problem in one doesn't necessarily affect the other, and you can far more easily compartmentalize one and not let it cross-contaminate, and maybe even raise funds here to do something about the problem over here. If you've got all your eggs in one basket, your ability to do that is a lot more limited. So just thinking strategically about where you're going with the business and reducing those risks, particularly at a time when there's strong economic headwinds, going back to the first slide, it's potentially a good time to be thinking about doing that. So quickly on the current funding landscape, we have had a glut of government schemes backing up business borrowing over the last 18 months. Who didn't take on a bounce back loan or a CBILS loan? For a lot of businesses, now they've started making repayments. The government are making a lot of noises about people who took that, people who may have taken that on, let's call it semi-fraudulently, because a lot of these are self-certified loans. I think that's a big red herring. My view on that is that, okay, there's going to be a bit of fraud in all that scheme, but it's the price of doing business and it's the price of saving an awful lot of jobs. The knock-on effect of that is that there's a new government loan scheme, that CBILS and BBILS, the coronavirus borrowing loan and the bounce back loan, those are finished now. They've been replaced by a new scheme called the Recovery Loan Scheme, RLS. We'll come on to that in a moment. But the main schemes are finished. A lot of businesses have got these, and they are low interest rates, and the security package is generally light. So unless there is a really compelling reason, it's best to leave those in place when you're looking at a refinancing and when you're doing a review of the business. We always advise clients, if you can, just leave them in place, particularly bounce back loans, the ones that were up to £50,000, because they've got no security, they've got a really good interest rate. Why wouldn't you leave them in place? Why would you refinance that to get a higher interest rate, a more onerous security package? Now, again, it comes back to the issue of security, but there's generally no security around these type of loans. So it doesn't stop you going and refinancing other aspects of the business or raising more money elsewhere. The recovery loan scheme, the replacement scheme, that was launched, I think, in March. We've seen quite a lot of reticence on the high street banks to undertake, to fully get behind this scheme, to really put money out there for businesses that need it. One of the, shall we say, smoke and mirror aspects of government announcements on these type of loans is this 80% government guarantee. So a lot of people don't realise that, okay, yes, there is an 80% government guarantee, but the government guarantee doesn't get called on first. So if you have, let's say, a £250,000 RLS loan, and you have a problem with the business and the bank calls it in, they will go through all their other procedures first. So if there's, okay, so let's think about a big loan. Let's talk about 500,000 loan, because that carries security. Okay, so there'll likely be a debenture, there'll likely be a 20% director's guarantee. The bank is obliged to exhaust those avenues of recovery first. So it may be that it takes 12 months for a liquidator to sell off all the business assets, get all the money in, and that might raise 25% of the outstanding loan amount. Then the bank needs to enforce the guarantee that they have against the directors. That might take another 6 months, and it will be 20% of the loan amount, and whatever you settle at will be whatever you settle at. It's only then that the government guarantee kicks in, and it's 80% of the remaining amount. So the bank goes through a procedure of its normal collections process first, and then the government covers 80% of what's left. So there is still an awful lot of pain to go through for a bank, and particularly for directors in this situation, if the worst should happen. Because of that pain, banks are very circumspect about doing these loans. It was slightly different with the previous ones, the C-bills loans, but with the RLS scheme, they're a lot more circumspect. We're almost back to the case that they'll lend it if you don't need it, but unless there's a really compelling reason, then the high street banks really aren't in the game with this particular loan scheme at all. One of the underlying things here is that banks are terrified that the government is just not going to pay out on its loan because the wrong paperwork's been filed, or procedures haven't been followed, or they are working on a different definition of the viability of a business, etc., etc. We've seen it in the past with various government loan guarantee schemes where the government actually haven't paid out whole swathes of guarantees, almost on a loophole. Now, it is the case that the banks were doing things that were probably not within the spirit of the scheme, but it's that kind of experience that means that there is a reticence within the banks. It has to be said, not all the banks. Metro in particular talk a very good game on using the RLS scheme. But where it's at with this particular scheme is the non-bank lenders, and there are plenty of them. You only have to go on the British Business Bank website, and there's 40 or 50 different providers of this type of loan scheme. Now, some of them only do it in a certain geographical area. Some of them will only do it for asset finance or to back up invoice finance. There are less providers who will do this sort of thing just for a standard working capital loan. But again, we know the market, we know who to approach for that kind of thing. We know which borrower fits in with which particular situation best. So, conclusion. Well, the broad sunnier plans that were promised us a couple of years ago, they've been delayed for various reasons, not least of all the pandemic. But having said that, there's still opportunities for growth. There are some businesses out there that are doing very, very well, that have been able to take advantage of the current situations just because they've worked in their favour. A few months ago, there was a lot of talk about the new roaring 20s coming back, about the next few years being high growth, lots of opportunities, businesses expanding, etc., lots of consumer spending. I think we'll see what happens with that, but it's certainly the case that there are opportunities for acquisitions out there. There's opportunities for specific sectors to grow. There's certainly cash washing about in the business sector, looking for a home. Some of it's equity based, a lot of it is loan based, and again, lots of different lenders have different flavours. It also depends on your borrowing capacity, which brings us right back to how fit is your business to borrow. If you've got no borrowing, what does it look like at the moment? If you've got borrowing already, is that sucking cash out of the business? Is it working for you? That's why it's always important to regularly assess your existing borrowing in light of what you want to do next with the business. I think one of the key takeaways that I would give, just to end things, is in uncertain times, it's best to surround yourself with a blanket of cash. And I think a lot of businesses are doing that at the moment. If that means a bit of preemptive borrowing, then that may be the way to go. If it means just tweaking your business terms so that you're getting paid earlier, you're collecting your cash in better, you're stretching some of your supplier terms, so you've got more cash sitting in your bank account, then that's probably the best thing to do at the moment. And I think that brings us to an end. So, any questions?
Yes, thank you for submitting your questions. There are just a couple of that need answering, Steve. So the first is there much appetite for lenders at the moment?
Yeah, well, I mean, okay. So the reason, the answer is it depends. It depends what you're trying to do. Generally, the lending market is very fragmented. There's the main high street banks who are fairly moribund in lending. They'll do some things, they probably won't do most things, but there was quite a dynamic lending sector developing after the financial crash. So, you know, from 2010 onwards, led by people like Funding Circle, but you've also got people like Starling Bank, Atom Bank. There's a number of institutional lending funds like Triple Point, Blackfinch, people like this that do particular types of lending. They have particular funds that they want to allocate to particular sectors, or particularly to management buy-ins or acquisitions or asset finance or commercial mortgages. So really it's there is an awful lot of appetite out there, but it depends what you're doing, and it depends on the specifics of your business. So if you've got a really nice business with fairly minimal borrowing, and you want to buy a new piece of equipment, you'll have lenders falling over you to do that. If you have a business that's let's say resurrected from the ashes of another, and you're looking to expand through some sort of working capital finance, the market's probably a bit more restricted for that, but there should be something that we can do. So yeah, the answer is yes, but it depends.
Okay, thank you. And finally, how do I establish if the finance I currently have in place is the most suitable for my business?
You talk to an expert. Could be someone from Jerem's Corporate Finance. There are lots of other experts out there, but we'd obviously like you to come and talk to us. So contact details are on the screen there. If you'd like us to come in and just do a free quick review of where you're at the moment, what opportunities exist, talk to you about some future plans and how they could possibly be financed, then yeah, more than happy to do that. But yes, talk to an expert.
Okay, thank you. So yes, thank you for attending. And like Steve said, if we can help with you in any way, please do get in touch. Thank you for joining.